Warren Buffett is renowned for his insightful perspectives on investing, and one of his most quoted remarks centers on the concept of risk. He famously stated, "Risk comes from not knowing what you're doing." This phrase has been widely interpreted and discussed within financial circles, often serving as a guiding principle for both novice and experienced investors. But what does it truly mean to know what you're doing in the world of investing? In this section, we set the stage for a deeper exploration of Buffett's philosophy, examining how understanding and knowledge can fundamentally change the way we perceive and manage risk. Many people assume that acquiring more information automatically reduces risk. This belief is especially common among investors, who often feel that thorough research and analysis can eliminate uncertainty. However, this mindset can foster overconfidence, making individuals less cautious and more likely to overlook potential pitfalls. When investors become convinced that their knowledge shields them from risk, they may take on excessive exposure or ignore warning signs. In reality, even the most informed decisions carry inherent unpredictability. Overestimating the power of knowledge can leave investors vulnerable to unexpected market shifts and losses. Recognizing the limits of information is crucial for maintaining a balanced and resilient investment strategy. Many investors approach decision-making with a checklist mentality, relying on a series of standard questions or criteria to guide their research. This method often creates a false sense of security, as ticking boxes can feel like thorough due diligence. However, superficial research rarely uncovers the deeper complexities or unique risks associated with an investment. By mistaking this surface-level process for genuine understanding, investors may overlook critical factors that could impact their returns. The illusion of protection can lead to complacency, leaving them vulnerable to unforeseen challenges. True insight requires moving beyond checklists to engage with the nuances and uncertainties inherent in every investment opportunity. Overconfidence can be a significant risk for new or amateur investors. When individuals overestimate their understanding of markets or financial instruments, they may make decisions without fully grasping the potential consequences. This misplaced confidence often leads to taking unnecessary risks, ignoring warning signs, or failing to conduct thorough research. Many novice investors believe that early successes are a sign of skill rather than luck, which can reinforce risky behavior. Without recognizing the limits of their expertise, they may overlook important details or misinterpret market trends. Ultimately, overconfidence can result in substantial financial losses and missed opportunities for learning and growth. Warren Buffett's famous quote highlights more than just a cautious approach to investing. At its core, it emphasizes the value of truly understanding the areas in which you operate. Buffett advocates for humility, urging investors to recognize the limits of their knowledge and to avoid venturing beyond them. This concept, known as the circle of competence, encourages individuals to focus on industries and businesses they deeply comprehend. By doing so, investors can make more informed decisions and reduce unnecessary risks. Buffett's philosophy reminds us that success often comes from knowing what not to do, as much as knowing what to pursue. The concept of the circle of competence refers to understanding the boundaries of one's own knowledge and expertise. Warren Buffett emphasizes the importance of recognizing these limits as a cornerstone of effective risk management. By focusing only on areas where he has deep understanding, Buffett avoids making decisions based on speculation or incomplete information. This disciplined approach helps minimize unnecessary risks and prevents costly mistakes. Knowing what you don't know is just as crucial as knowing what you do, and staying within your circle of competence allows for more informed and confident choices. Ultimately, this principle guides investors to make decisions rooted in clarity and self-awareness, rather than overreaching into unfamiliar territory. In any form of analysis, striving for perfection is often unrealistic. The complexity of real-world scenarios means that unexpected variables and errors are inevitable. Recognizing this, investors and analysts rely on the concept of the margin of safety. This principle acts as a protective buffer, allowing for a degree of error in calculations and assumptions. By accepting that some level of imperfection is unavoidable, the margin of safety helps safeguard against unforeseen risks. It encourages a more cautious approach, reducing the likelihood of significant losses when outcomes deviate from expectations. Ultimately, embracing imperfection and prioritizing a margin of safety are essential for making sound, resilient decisions. Warren Buffett and his mentor, Benjamin Graham, approached investing with a unique philosophy centered on humility and the acceptance of their own limitations. Rather than relying solely on academic theories or complex financial models, they acknowledged that no one can predict the market with absolute certainty. This mindset led them to focus on value investing, seeking companies that were fundamentally sound and undervalued, rather than chasing trends or speculative opportunities. By admitting what they did not know, Buffett and Graham were able to avoid an overconfidence and costly mistakes. Their strategies emphasize patience, discipline, and a willingness to learn continuously. In doing so, they demonstrated that true wisdom in investing often comes from recognizing and respecting the boundaries of one's own knowledge. Gaining true investment knowledge goes beyond analyzing financial statements and market trends. It requires a deep understanding of the people involved: customers, managers, and business leaders. Customers drive demand and shape the direction of products and services, while managers influence day-to-day operations and company culture. Business leaders set the vision and make strategic decisions that can impact long-term growth. By appreciating the motivations, values, and behaviors of these individuals, investors can better assess risks and opportunities. This human element often reveals insights that numbers alone cannot provide, making it a crucial aspect of successful investing. In today's fast-paced financial landscape, a phenomenon known as the Dunning-Kruger portfolio has emerged. This term describes investors who possess only a partial understanding of markets, yet display unwarranted confidence in their abilities. As a result, they often make concentrated bets on a narrow selection of assets, believing their insights are superior. Such portfolios tend to be fragile, lacking proper diversification and risk management. Overconfidence can lead to ignoring warning signs and failing to adapt to changing conditions. Ultimately, this approach exposes investors to significant losses when market realities contradict their assumptions. Recognizing the limits of one's knowledge is crucial to building resilient, well-balanced investment strategies. Specialists frequently focus on technical details, but certain risks can slip through the cracks. Valuation risk, for example, arises when assets are purchased at inflated prices, potentially leading to disappointing returns. Cyclicality is another factor often underestimated, as industries can experience sharp downturns that erode portfolio value. Additionally, management quality plays a critical role. Weak leadership can result in poor strategic decisions and operational inefficiencies. Overlooking these elements can undermine the stability and growth of an investment portfolio, leaving it vulnerable to unexpected setbacks. Recognizing and addressing these blind spots is essential for building resilient and successful portfolios. The vast amount of information available online can create a sense of false confidence among investors. With endless articles, forums, and data at their fingertips, individuals may begin to believe they possess unique insights or superior knowledge. This misplaced assurance often leads them to dismiss fundamental principles like diversification and the margin of safety. Instead of spreading risk across various assets or maintaining a buffer against potential losses, overconfident investors might concentrate their portfolios or take on excessive risk. Such behavior increases vulnerability to market volatility and unexpected downturns. Ultimately, the illusion of expertise fostered by information overload can undermine prudent investment strategies and expose individuals to greater financial danger. From the prudent investor's perspective, knowledge is not a source of arrogance, but a foundation for humility. Recognizing the limits of what can be known encourages caution in decision-making. Instead of fueling overconfidence, information should prompt investors to question assumptions and remain vigilant about potential risks. This mindset leads to demanding a margin of safety or a discount, acknowledging that uncertainty is always present. By reframing knowledge as a tool for careful analysis rather than hubris, investors position themselves to make wiser, more resilient choices in an unpredictable market. Recognizing the limits of your own knowledge is a crucial skill for any investor. By clearly defining what you don't know, you avoid making assumptions that can lead to costly mistakes. This self-awareness acts as a safeguard, helping you steer clear of investments that fall outside your expertise or understanding. It encourages a disciplined approach, prompting you to seek additional information or expert advice when necessary. Ultimately, acknowledging your blind spots reduces exposure to unforeseen risks and helps maintain a more resilient investment strategy. In the unpredictable world of markets, knowing what you don't know can be just as valuable as knowing what you do. True knowledge often brings a sense of caution, prompting us to pause and carefully consider our actions. Rather than rushing into decisions, those who understand the complexities of a situation are more likely to wait for the right moment. Great opportunities are rare and seldom present themselves without warning. Recognizing this, wise individuals exercise patience and discipline, knowing that impulsive actions can lead to regret. By waiting for genuine opportunities, they position themselves for greater success and avoid unnecessary risks. The true purpose of investing goes beyond simply searching for risk-free opportunities. Instead, it centers on recognizing and understanding the risks involved in any investment. By doing so, investors can make informed decisions and ensure that they are adequately compensated for the risks they choose to take. Rather than avoiding risk altogether, successful investing means accepting that risk is inherent and negotiating returns that justify those risks. This approach allows for more realistic expectations and a stronger foundation for long-term financial growth. As we reach the end of our exploration, it's important to remember the value of humility in decision-making. Warren Buffett's quote serves not as a badge of pride, but as a reminder to approach challenges with caution and self-awareness. Overconfidence can cloud judgment and lead to costly mistakes, while humility encourages us to recognize our limitations and learn from others. By resisting the lure of hubris, we open ourselves to wiser choices and more sustainable success. Let Buffett's words guide you toward thoughtful action, grounded in respect for the complexities of the world around us. Unexpected risks are a part of every investor's journey. Take a moment to reflect on your own experiences. What surprises have you faced, and what lessons did you learn from them? Sharing your insights can help others navigate similar challenges. If you have a favorite investing quote or a piece of wisdom that has guided you, consider suggesting it for future analysis. Your contributions not only enrich the conversation but also foster a community of learning and growth.